Good morning, friends. I hope you are having a good Sunday. Now, today, this video is about an assortment of topics. First, I'll show you the mistake I made and a lot of other people made about the market. And, the point is, a lot of people are saying the market did something that they did not expect. Okay, we'll study what should have been expected. Number two, what is the concept of choppy waters and clear meadows? Okay, and the third is the concept of a time stop. And a lot of people are asking me, how they should exit and, you know, uh, how they should manage their trades. Now, let's start with the first topic, which is the way uh, to look at the market and what sort of mistake people made, including me. And it is very important to go over charts post the trading week to see what could have been done differently. So let's remove the previous lines. Now, this first average is the 20 DMA. This is the 50 DMA. Okay. Now we can see here on 14th of July, you made a low of 10,560 thereabouts. On 16th, 15th of July, you again made a low of about 10,580. This was the Reliance AGM day. And again on 16th, you made a similar low. Now, lots of people took this bar to be an extremely bearish bar and expected downside. Fundamental mistake here. We all know the 200 EMA was about 10,550. You went into 10,550 once, you went into 10,560 two times, then you went to 10,580 a third time. What is the trend? The trend is up. Should you be selling into a known support when the trend is up? I think that is the first question that needs to be asked of people, that they shouldn't have been selling into this zone or selling in general. Why? Because a market which is in an uptrend will trap the short sellers and will rocket on the upside. Okay. Since we are on this chart, let me show you the other concept of muddy ground or muddy waters, as you may want to call it. See, the issue I am facing with this, and maybe somebody can help me. I like to use the Epic Pen, and apparently for a Mac, there is no Epic Pen. So that creates a huge problem if I have to draw. So if any of you has a certain idea of an Epic Pen which can be used for a Mac, I'll be extremely grateful. But as of now, I have to use this sort of. Okay, now this is a muddy water. Okay, again, this is a muddy water. Okay, this is a muddy water. This sort of choppiness at different intervals is a muddy water. Now, a lot of people, the moment the market comes out of uh, this consolidation or choppiness, their targets are 100 points higher. My concept or my theory is that, say, on Friday you came out of a choppy situation. If you hold till next Friday, so 1, 2, 3, 4, 5. By this time, you have captured 80% of the entire move instead of trying to give these small targets which will be achieved. A lot of targets are given in a manner because they will get achieved, so you can then finally talk about I told you so, etc. Here, if this was the bar we came out on, 1, 2, 3, 4, 5, again, if we came out of this choppy water, maybe say even here, 1, 2, 3, 4, 5, it gave you almost 80% of the move before the market went into a consolidation again. Now, this can differ according to trends. In a much stronger trend, you could have maybe a 10-day upside. So if you look in the past and see how holding for a X number of days made you capture 80% of the move, generally the move is fastest out of the blocks. Okay. So if you hold your position for the next 5 days, generally in most cases you'll get 80%. But if a trend is very strong, then you can change it from 5 to 7, etc. Those sort of modifications you can make. Now, what sort of a trailing stop can you keep? Okay. Now here, this is the 60-minute chart. Okay. Then you have a 30-minute chart. What you have to see is what average is the market respecting on any time frame. Okay. So I think that a 30-minute average, the 20 period average so far is looking like this the market is respecting. So you can start to trail on this average, and you want a couple of closings below it to be out. So, excuse me. One issue is that the time stop has to be kept in mind in terms of target. Second issue is don't get bumped off without any reason. So choose this average as your trailing stop. This is about 10,800. You are at about 10,930, 935 thereabouts. So I would think that, you know, having this kind of a trailing average and a Friday's target that by Friday most of this move should get captured, that will keep you safe. Okay, since we are on the topic, let's see what is happening on the US indices. Now, US indices seem to be in some sort of a choppy water. And if they start to get out of this 3240 on the S&P 500, there should be continuation of the uptrend. So in those terms, for the moment, I don't think there is great amount of negativity on US market. Again on Nasdaq, this does not look very bearish. This is Nasdaq 100. So you can again, look to the upside. Now, one interesting thing I would like to show you. Let's go to the 15-minute chart of the Nifty. Can you see this? This last bit on Friday. Do you know what is this? This is the 5-minute chart. So in basically half an hour, you went from 820 to 930, because this was where the shorts had their stops. And this sort of action on the upside or downside happens when stops are hit. So my guess would be that there should still be people who are short at 11,000, and short as in call shorts, 11,100, 11,200, and those volumes are also large. I mean, there is lots of open interest. So if the market starts to pierce through, the short covering you have seen till now is nothing. Okay. So this you should keep in mind. So to summarize, A, never short into a support in an uptrend, never go long into a resistance in a downtrend. The second part, look for these congestion zones to prepare for the next move, because most of the move or most of the money is made in these expansions. Okay. Number three, have a time stop so that the market is given full opportunity to go to its potential. Okay. You need large profits to offset losses. So these are the 3 points I wanted to make, plus show you some international charts, which despite a slowing of momentum, there is no question there was a slowdown of momentum, are not able to go down a whole lot. And basically what I said, till global markets don't go down, we go up, and we are starting a phase of outperformance. Last few times we have gone up about 3 to 400 points from the consolidation. So similar sort of level you should expect, a 3 to 400 point rally, and in about a week's time you will probably get the entire juice out of this move on the Nifty. Now I hear a lot of people saying all-time highs are possible. I think they are, and a lot of articles, particularly on these, financial newspapers, that there is disconnect between economy and market and this and that. I think that those people, they don't understand the market. The market does not have one-on-one correlation all the time with economy. In the long run, they converge, but market moves ahead much further than the economy does. COVID cases, we've had a nice dress rehearsal. So the market is taking those cases in its stride. There is a bit of confidence that sooner or later the vaccine, etc., comes out. So that way, I don't think the market is fearful. So basically, the idea should be to remain as long as possible, long as in buy stuff and stay on the upside, and give the market time to play out. Having these cute targets of 11,050, etc., will not help. And so far, the market has crossed all targets and made higher highs. So that should be it for this weekend, I hope. And have a good trading day. Take care, trade well, and please consult your financial advisor.